Realty Income stock is down another 5.67% today and continues to free fall. It's now trading with a 6.27% dividend yield. And what we're going to do today is look at what caused this massive share price decline. And then we're going to look at whether that was actually good for the company long term or whether it might be worse. So if you'd like to listen to that type of content, I encourage you to watch this video. And if you like the content of this video, give it a thumbs up and subscribe. So without further ado, let's go and dive right in. So what caused this massive price drop here today of 5.67%? So Realty Income actually announced that they're going to be acquiring Spirit Realty. So let's go and dive right into the details of this acquisition. So here's the transaction overview from Realty Income, and it has specific segments which we will look at. So the transaction structure, it's going to be an all-stock acquisition by Realty Income of Spirit Realty. So this means that Realty Income is going to be issuing a bunch of its own stock to the stockholders of Spirit Realty Capital. So Spirit shareholders are going to receive 0.762 of a share of Realty Income for each Spirit common share. So again, they will be receiving shares of Realty Income at 0.762 for every share of Spirit Realty Capital that they currently own. Now, this represents, once the transaction is done, ownership of Realty Income of 87% for current Realty Income shareholders and 13% for Spirit shareholders. Leverage neutral transaction requiring no external capital. So again, there was no other capital here. It was an all stock acquisition by Realty Income. So right there, we know when we issue all stock acquisitions, us as shareholders, we get diluted further because our company is issuing stock to the acquisitioners or the acquisitionees, in this case, for their stock in Spirit. So we are getting diluted, and that again usually affects the share price of us Realty Income shareholders negatively. Now, management and the board, no anticipated changes to Realty Income's executive management or board of directors. So again, that's great news. Again, keeping in line with that great management team here at Realty Income. Anticipated synergies and earnings. So again, is this acquisition going to actually be beneficial to us Realty Income shareholders, or is it not? So they're saying that they anticipate approximately 50 million of G&A synergies, so general and administrative synergies, or approximately 30 million of synergies excluding stock-based compensation, representing approximately $0.03 per share. So again, they are saying that we will be saving roughly $50 million of general and administrative synergies through the use of this transaction, which is expected to be over 2.5% accretive. Again, the keyword being here accretive to Realty Income AFFO, or adjusted funds from operations per share. So this is great. This acquisition will actually boost our AFFO per share, if you are a Realty Income holder as myself, and it's going to be 2.5% accretive. So again, being beneficial to me or you as a Realty Income shareholder. Now, Realty Income does not intend to change its regular dividend as a result of this transaction, so that's great. And it is going to keep paying that monthly dividend along with quarterly dividend increases to its shareholders. Now, when is this transaction going to take place? It's expected to close in Q1 of 2024, subject to Spirit shareholders approving this transaction. So that was the overview. Now, we want to look at what we actually acquired if we were Realty Income shareholders and what we're getting a piece of. So let's go and look at Spirit and the transaction rationale behind this. And then we'll look at actual details about Spirit Realty's business. So again, rationale, this is going to be just restated in a couple parts, but immediate AFFO accretion and meaningful anticipated annual cost synergies. So like we saw, 2.5% accretion to our AFFO per share and annual cost synergies or cost savings of anywhere from 50 million to 30 million, excluding stock-based compensation. So attractive capital stack requires no new capital to raise to fund the acquisition. So again, they didn't have to raise any capital here. It was an all stock-based compensation deal. But again, us as shareholders, we are being diluted. Now, what's really cool here is this type of benefit that we generate by acquiring Spirit Realty is the debt that they currently have in place in their business. So expected to benefit from Spirit's $4.1 billion of debt with a weighted average cost of capital here at 3.48% in a term of 5 years. So having that locked in at such a low debt rate is great. 3.48% for $4.1 billion of Spirit Realty's assets and debt locked in for 5 years. So again, very, very great here. Great financing. And again, in 5 years, hopefully rates do decrease and then they can continue to take advantage of lower costs of capital. So complementary portfolio exposure improves their diversification and increases investment capacity across key industries and clients. So this speaking to the portfolio, which we will look at in a minute, Spirit Capital's portfolio and their specific properties, as well as their industries and clients. So here they're stating Spirit's portfolio comprises of 51% of non-discretionary and service retail assets. And what I'm really excited about here is 26% in industrial. So Realty Income historically has not had a lot of exposure to the industrial properties. So industrial properties, again, in my opinion, they are great properties, very, very great AFFO per share. And again, the market also values industrial properties at a higher valuation. So the more exposure that Realty Income ends up getting to industrial properties is going to be great here for their long-term growth. Now, 14 of the top 20 clients overlap with Realty Income's on a combined basis, allowing Realty Income to reinforce and deepen these existing relationships with these key clients. So again, they're buying assets that have tenants that are currently in Realty Income's properties. So again, Realty Income is sort of expanding on what they already know. And by doing this, they are already have existing relationships with these clients. They know what these clients want and the type of things that they desire from their properties. So this sounds like it is actually a great acquisition from that perspective. So greater client and industry diversification allows Realty Income to extend its runway for growth in target areas and amplifies its competitive advantage. So again, just speaking to Realty Income's niche, this is what they specialize in. They saw Spirit Realty here, and they decided that they could add it to their portfolio, and it would be a little bit of more of the same with an extra exposure in industrial. So conservative underwriting of credit. Again, this just speaking to the portfolio underwriting and the opportunities for their upside. Preserves best-in-class balance sheet. So here again, speaking to Realty Income's liquidity, access to capital, and their debt maturity, whether it's manageable or not, they still believe that it is. So that's great. So that was kind of the transaction rationale. And again, great points here in my opinion. But let's go and dive right into the details. So number one, the immediate AFFO accretion and meaningful anticipated annual cost synergies. So this is that 2.5% AFFO per share accretion to Realty Income shareholders. And they're saying it might even be over 2.5%. So what's going to make this up? How are they going to achieve over 2.5% of AFFO per share accretion to shareholders? So it's going to consist of below the market capital stack, operating cost savings, and a multiple differential. So below market capital stack, again, we saw this, but Spirit Realty's $4.1 billion of debt is at a super low interest rate here at 3.48% for the next 5 years. So again, nice cap rates they can lock in here. Operating cost savings, again, we looked at this, but approximately $50 million of general and administrative synergies, or $30 million excluding stock-based compensation. And then they're going to achieve these efficiencies by reducing overhead and other corporate costs. Again, basically meaning they're going to focus on efficiencies of their current business and work that in with Spirit's business model as well. Multiple differential, so natural accretion as a result of Realty Income's relative trading multiple premium. So again, Realty Income trades at a higher trading multiple on an FFO basis or AFFO basis than Spirit trades kind of at a higher 12 or 13, and then you have Spirit kind of trading at that 9. So you're getting a multiple expansion there as well. All right, so let's look at Spirit's complementary portfolio and how it aligns with Realty Income's core strategy. So this is detailing Spirit's properties. We have about 2,064 properties, represents 61 million square feet. It's 345 clients in these properties. Nice high occupancy rate here of 99.8%. So that is great. the WALT, or the weighted average lease terms in terms of years. A nice 10.3% lease term here, so great. ABR, so that's annual base rent, $695 million of annual base rent. So as we can see here, they have a nice pie chart detailing what type of their portfolio is made up of in terms of the ABR, or annual base rent. So 39.8% of service retail, 25.7% of industrial, so nice exposure here to Realty Income. Then they have 14.6% in discretionary retail, 11.4% in non-discretionary retail, and 8.5% in other. So great portfolio here in my opinion. Nice occupancy rates, decent amount of property, good annual base rent, and a nice mix of portfolio composition here for Spirit Realty. Now let's look at the actual tenants for each of Spirit Realty here. So again, Spirit Realty has that industrial portfolio and that retail portfolio. So we're going to look at both. So again, the retail portfolio does represent the majority of their annual base rent. Again, if we looked at it again, it was $695 million, and about $457 million of that 695 is in the retail sector. And as we can see here, they still have that nice long weighted average lease term, and their tenants here, again, a lot of overlap with Realty Income. You have Dollar General, you have BJ's, Home Depot, Lowe's, Tractor Supply Co., Circle K, CVS. So a lot of overlap here, and this is what they were speaking to. So again, this is going to be right in Realty Income's wheelhouse. They know these clients, they have these relationships already, so they're just adding on additional properties where these tenants already do business. And again, they know what these tenants want. So great addition here to Realty Income's core portfolio or niche. Now, the industrial portfolio here is smaller in terms of annual base rent, again at 180 billion compared to the 457 billion here of the Realty. But again, nice long lease terms here, even higher at 12.4 years. And again, a lot of these clients Realty Income might not be as familiar with, but because of their management team and board of directors, I believe they will have no problem establishing these relationships. And again, these are companies that we know, FedEx, GXO, we have Whirlpool. So again, these are still large companies, and they're split up between manufacturing, distribution, industrial, outdoor, and flex. So nice addition here in terms of diversification for Realty Income in industrial. Now, one thing to be concerned about here is they are sort of moving out of their niche of realty or real estate here. So they've always focused on having these nice retail properties that they can manage, and they've excelled exceptionally at that. But now they're moving into the industrial side, and like I said, they may not be as familiar with that, and a lot of people look at that as a negative. In my opinion, I think that it's going to be a long-term positive once they figure out how to cater to these industrial clients. Again, there might be some kinks to work out there, so short-term risk, but I think it's going to have a long-term positive net value for Realty Income. All right, so here again, looking at this from both a Realty Income perspective and a Spirit Realty, and then looking at it after this transaction has been combined. So again, Realty Income's net debt to preferred annualized adjusted EBITDA has always been 5.4 times. Spirit Realty a little bit higher. Again, after this transaction, it'll be about 5.4 times. So really the same. And that's really the case here with all of these different metrics. So fixed coverage ratio, 4.6 to 5.2, still going to be 4.6 times. Unsecured assets, 2.6 to 2.6 across the board. Secured debt here to gross assets, 1.8% to 0, so blended at 1.5%. The total debt here, 39.5% of gross assets. Spirit Realty had a little bit higher, a little bit lower at 39, blended at 39.4. So again, a nice blend here. So this addition really keeps Realty Income's balance sheet in a very strong position. And again, all of these ratios stay relatively the same after this combination or acquisition. All right, so let's look at the beginning, the acquisition, and the end when they're combined. So Realty Income, again, the total enterprise value here, 54 billion. When you add in Spirit Realty, it's at about 9 or 10 billion. The combined valuation here being $63 billion. So Realty Income had roughly 13,000 properties. It's added another 2,000 through this acquisition. It'll bring them up to 15,000 properties. Now the portfolio and annual contractualized base rent, $3.8 billion here. Adding Spirit Realty adds another $0.7 billion, bringing it to a total of $4.5 billion. Now the weighted average lease term here, again, very similar, comes out to about 9.7. The occupancy here, again, 99% for Realty Income, super great. Spirit Realty even higher at 99.8, resulting in that nice 99.1% occupancy. So the lease expirations, so Realty Income from now until 2026 has about 15% leases coming up due for refinancing, or sorry, lease expiration. So 15% here, again, coming up where they'll have to negotiate with their tenants and then try to keep them locked in for another 6, 7, 8, 9, 10 years. So again, they'll have to negotiate this with their tenants. So 15% of their tenants are going to be coming up, and Spirit Realty 12%. So again, coming in at 15%. Up for renegotiation with their tenants. So top 10 client concentration, again, very similar, 27% to 22%, blended at 25%. And industry concentration, Realty Income is much more concentrated here in terms of specific industries, 62%. Spirit Realty, a little more fragmented at 39%, combined being 58%. So investment grade tenants, Realty Income has 40%, Spirit Realty a lot less. Highly graded investment grade tenants at 19%, so 37% here. And when we look at the portfolio type concentration, again, Realty Income had 82% in this realty or this retail sector. Like after this acquisition, it'll be closer to 80%. Industrial, they'll have a step up, about 2% at 15.1%. Gaming, relatively the same, and other relatively the same. It just a little bit higher here on Spirit's side. So again, what do I think of the overall transaction now that we've gone through it? I think that it's pretty accretive. Like we saw, like Realty Income said, they're gonna have 2.5% increase in AFFO per share, and they're gonna be saving 50 million, anywhere from 30 to 50 million dollars annually in terms of synergies. And they are focusing on acquiring companies that look like the majority of their business, like Spirit Realty, is in that retail sector that Realty Income does have exposure to. Again, they're also getting exposure to industrial properties, which is kind of like a double-edged sword. It is great in the sense that they're diversifying their revenue streams or getting additional properties in other sectors, but that can also be bad if they are not able to do this transition or make this transaction happen in an accretive way or a beneficial way in terms of the industrial sector. So again, they have less experience in this sector. They've always focused on this retail sector, so it could be beneficial, but again, there probably will be some kinks to work out in the short term. Again, I think that they paid a pretty decent valuation. This was a fair price. It wasn't anything undervalued or overvalued for Spirit, pretty much in line with what I thought. And in terms of Realty Income's future growth, this is going to be one of the only ways they can really grow. They've already grown to 54 billion. After this acquisition, it's going to be 63 billion dollars. Growing organically anymore is going to be super hard for the future. They're going to have to keep making acquisitions like this every couple of years, because it's going to be one of the only ways that they can actually grow accretively or beneficially for shareholders. Again, it sucks because we are getting diluted, but if the acquisition is going to provide long-term value for us shareholders, then we kind of have to be fine with that growth path, because they've grown to a point now where they're so big that growing organically is just not going to be in the cards, in my opinion. They can still have natural growth, but it's not going to be anything meaningful. It will probably be more and more acquisitions. So that was kind of what happened to Realty Income stock today. If you enjoyed the content or you had any questions or comments, please leave them in the comment section below. And if you liked the content, please give me a thumbs up and subscribe to the channel. It keeps me really motivated to keep doing videos like this for you great people here on YouTube. So without that, I will see you in the next video. Thank you for listening. Bye. Please note, I am not a financial advisor by any means. Please do your own due diligence when investing. Investing is inherently risky and you may lose money, and I am not responsible for any investing losses or decisions you make or incur. Thank you. Bye.